There are 800 million ounces of silver promised on paper. Only 28 million ounces exist in deliverable vaults. That's a 3-0-1 gap. If just 4% of contract holders demand physical delivery, the system collapses. Right now, 7% are demanding delivery, and the number is accelerating daily. This isn't speculation. This is forensic evidence. For 2 decades, JPMorgan Chase and the COMEX Commodities Exchange engineered the most sophisticated price suppression scheme in financial history. They sold silver that didn't exist. They manipulated markets with impunity. They convinced the world that paper contracts were as good as physical metal. And now the mechanism they designed to control silver has trapped them instead. Industrial demand is skyrocketing. Basel III banking regulations just outlawed their strategy. And the math says collapse is inevitable. This is the story of how the world's most powerful bank built a Ponzi scheme in precious metals, why they can't escape it, and what happens when 800 million ounces of promised silver meets 28 million ounces of reality. Welcome to Financial Detective, where we don't predict the future, we reveal the pattern. To understand the trap, you need to understand the crime. And the crime started with a simple idea: control the price of silver without owning the silver. In the early 2000s, JPMorgan and other major banks faced a problem. Silver was becoming too valuable. Industrial demand was rising. Investors were buying physical metal. And rising silver prices threatened the paper currency system because silver, like gold, is real money. It can't be printed. It can't be inflated. It's a threat to central bank control. So JPMorgan devised a solution: the paper silver market. Here's how it worked. COMEX, the Commodities Exchange in New York, allows traders to buy and sell silver futures contracts. Each contract represents 5,000 ounces of silver. In theory, these contracts are backed by physical metal stored in COMEX vaults. In theory, contract holders can demand delivery of actual silver, but JPMorgan discovered a loophole. They could sell unlimited paper contracts without holding the physical metal to back them. The mechanism is called naked shorting, and it's technically illegal, but enforcement is non-existent. Here's the specific scheme. JPMorgan would sell thousands of futures contracts, flooding the market with paper silver. This increased supply artificially, which drove prices down. When prices dropped, smaller investors panicked and sold. JPMorgan bought back the contracts at lower prices, pocketing the difference. Then they repeated the cycle. Between 2008 and 2020, JPMorgan executed this strategy systematically. They were caught and fined multiple times. In 2020, they paid $920 million in penalties for spoofing and market manipulation in precious metals. The Department of Justice called it a criminal enterprise. But here's what nobody understood at the time: the fines were irrelevant. JPMorgan made billions manipulating silver prices. A $19-20 million fine was just a cost of doing business. And they kept operating the same scheme because the profit was too enormous to stop. By 2022, the paper silver market had become a mathematical absurdity. The total volume of silver traded on COMEX exceeded global annual mine production by a factor of 330 to 1. That means for every physical ounce of silver mined, 330 paper ounces were being traded. This is the definition of a Ponzi scheme. Promise something you don't have. Rely on the assumption that nobody will demand delivery, and profit from the spread between paper price and reality. For 20 years, it worked. Investors bought paper contracts, collected profits, and never asked for physical metal. JPMorgan suppressed silver prices, protected the dollar, and made fortunes. The scheme was perfect. Until the rules changed. In 2019, the Bank for International Settlements, the central bank of central banks, introduced Basel III regulations. These rules were designed to prevent another 2008 style financial crisis by forcing banks to hold more capital and classify assets more honestly. Buried in Basel III was a clause that would destroy JPMorgan's silver scheme. Paper, gold, and silver would no longer count as Tier 1 assets. Let me translate that. Before Basel III, banks could hold paper contracts for gold and silver and call them risk-free assets on their balance sheets. It was the same as holding cash. This allowed banks to leverage paper metals infinitely without holding the physical commodity. After Basel III, paper metals became liabilities. If a bank sold a silver futures contract without physical metal to back it, that contract was now classified as a risky obligation. It required capital reserves. It increased the bank's risk profile. And most importantly, it made shorting silver extremely expensive. The rule went into effect in stages. By June 2021, it was fully implemented in Europe. By January 2023, it applied to US banks. And JPMorgan, the largest silver manipulator in history, was suddenly operating under a system where their entire strategy was unprofitable. But they couldn't just stop, because stopping would mean closing out their short positions, and closing those positions would require delivering physical silver they didn't have. They were trapped in their own design. Here's the specific problem. JPMorgan holds massive short positions in silver futures. Estimates suggest they're short over 300 million ounces. To close these positions, they'd need to either buy the contracts back at current prices or deliver physical metal. Buying back contracts would drive silver prices through the roof, triggering margin calls and catastrophic losses. Delivering physical metal is impossible because they don't have 300 million ounces. COMEX's entire registered inventory is only 28 million ounces. Basel III didn't just change the rules, it locked the trap shut. JPMorgan can't escape without triggering the collapse they spent 20 years trying to prevent. And then industrial demand started accelerating. Silver isn't just money. It's a strategic industrial commodity. And in the last 5 years, demand has exploded in ways that nobody predicted. Here are the numbers. In 2020, global silver demand was approximately 1 billion ounces annually. By 2024, demand exceeded 1.2 billion ounces. By 2025, it's projected to hit 1.3 billion ounces. But here's the problem. Annual mine production is only 850 million ounces. That's a 450 million ounce deficit every single year, and the gap is widening. Where is the demand coming from? 3 sectors: solar panels, electric vehicles, and artificial intelligence. Let's start with solar. Every solar panel requires silver paste for conductivity. It's irreplaceable. No other metal has silver's electrical and thermal properties at that efficiency. In 2024, the solar industry consumed over 200 million ounces of silver, approximately 20% of total supply. By 2030, solar demand alone is projected to reach 400 million ounces annually. Electric vehicles are the second driver. EVs use twice as much silver as traditional cars because of the electrical systems, batteries, and charging infrastructure. Tesla's Model 3 contains approximately 1 kilogram of silver. Multiply that by 10 million EVs produced annually, and you're looking at 320 million ounces consumed just by the EV sector. Artificial intelligence is the third accelerant. AI data centers require massive electrical infrastructure. Silver is used in semiconductors, circuit boards, and high-efficiency switches. NVIDIA's H100 GPU clusters, which power AI models, consume significant silver in their production. As AI scales, so does silver demand. Now here's where it gets catastrophic for JPMorgan. Industrial users don't buy silver on COMEX. They go directly to miners and refiners. They sign long-term contracts that guarantee physical delivery. Samsung, Tesla, and Chinese solar manufacturers aren't calling JPMorgan asking for paper contracts. They're buying every ounce that comes out of the ground. And when mine production can't meet demand, they turn to above-ground stockpiles. COMEX registered inventory has been hemorrhaging for 2 years. In January 2022, COMEX vaults held 95 million ounces of registered silver. By December 2024, that number dropped to 28 million ounces. That's a 70% decline in less than 3 years, and it's accelerating. In the first quarter of 2025 alone, over 8 million ounces left COMEX vaults. At this rate, registered inventory will be functionally zero by mid-2026. But remember, there are 800 million ounces of paper silver contracts outstanding. Those contracts promise delivery from vaults that are being drained by industrial users who don't care about futures markets. They need the physical metal now. JPMorgan sold contracts assuming nobody would demand delivery. Let's do the math because the math is damning. COEX registered silver inventory, 28 million ounces. This is the metal available for delivery against futures contracts. Open interest in silver futures, approximately 160,000 contracts. Each contract represents 5,000 ounces. That's 800 million ounces of silver promised on paper. Ratio, 28:5 to 1. Now, historically, only 2% of futures contracts demand physical delivery. Most traders close their positions before expiration or roll them into the next contract month. The system relied on this behavior. As long as 98% of traders took cash settlement, the Ponzi functioned. But that assumption is breaking. In February 2025, 7% of March contracts stood for delivery. That's triple the historical average. And delivery demands are accelerating monthly. Here's why. Investors are waking up to the scheme. They see industrial demand draining supply. They see Basel III regulations making banks desperate, and they're calling the bluff. They're demanding physical silver. Let's run the numbers. If 7% of the 800 million ounces in open interest demand delivery, that's 56 million ounces. COMEX only has 28 million ounces. They're already short by 28 million ounces at just 7% delivery demand. If delivery requests hit 10%, COMEX needs 80 million ounces. They'd be short by 52 million ounces. If it reaches 15%, they'd need 120 million ounces. They'd be short by 92 million ounces. At 4%, the system defaults. We're already at 7%, and the trend is accelerating. This is a mathematical inevitability. The vault cannot deliver what doesn't exist. And when COMEX defaults, when they announce they cannot fulfill delivery obligations, the paper-silver market collapses instantly. What happens next? Every contract holder will panic and demand deliveries simultaneously. The scramble for physical silver will send prices into a parabolic spike. And JPMorgan, sitting on 300 million ounces of short positions, will face losses in the tens of billions. This is not speculation. This is forensic accounting. The numbers are public. The inventory levels are reported weekly, and the gap is widening. JPMorgan built a trap where they sold 28 times more silver than exists. And now the trap is closing. Here's the final piece of evidence that the trap has closed. JPMorgan is switching sides. In March 2024, rumors began circulating in commodities markets that JPMorgan had quietly accumulated a massive physical silver position. These weren't just rumors. Regulatory filings and vault movement data confirmed it. Between 2020 and 24, JPMorgan took delivery of approximately 150 million ounces of physical silver. They stored it in private vaults, not COMEX-registered inventory. They didn't announce it. They did it silently, systematically, while publicly maintaining their short positions on COMEX. Think about what this means. The bank that spent 20 years suppressing silver prices is now hoarding the physical metal. The bank that told the world silver was overvalued is now accumulating the largest private silver stockpile in modern history. This is the insider flip. JPMorgan knows the system is breaking. They know Basel III makes their short strategy unsustainable. They know industrial demand is draining supply. And they know that when COMEX defaults, physical silver will be worth 10, 20, maybe 50 times the current paper price. So they're doing what criminals always do when the cops are coming. They're grabbing the loot and running before the building collapses. Here's the specifics. JPMorgan likely accumulated this silver at suppressed prices, using their own manipulation to buy low. They shorted paper silver to drive prices down, then took delivery of physical metal at those artificial lows. It's front-running on an institutional scale, and now they're positioned perfectly. When COMEX defaults, JPMorgan's short positions will be closed at artificially low settlement prices, because the exchange will declare force majeure. But their physical silver, held privately, will be valued at the real market price, which could be $100, $200, or higher per ounce. They won't lose billions. They'll make billions. They engineered the collapse, positioned themselves to profit from it, and left every other market participant holding worthless paper. This is not conspiracy theory. This is standard bank behavior. In 2008, Goldman Sachs shorted subprime mortgages while selling them to clients. In 2020, JPMorgan was fined for precious metals manipulation. And now, in 2025, they're executing the same strategy. Create the crisis, profit from the chaos. The silver trap isn't closing on JPMorgan. It's closing on everyone who believed the paper market was real. JPMorgan already escaped. They just haven't told anyone yet. So what happens next? Let's walk through the sequence, because the pattern is predictable. Stage 1, accelerating delivery demands. We're here now. Every month, more contracts stand for delivery. Every month, COMEX inventory shrinks. The ratio between paper claims and physical metal widens. Stage 2, COMEX declares force majeure. When the vault runs dry, when they physically cannot deliver, COMEX will invoke force majeure, a clause that allows them to settle contracts in cash instead of metal. They'll offer paper dollars for silver contracts at the suppressed COMEX price. This is legal theft. Contract holders bought silver. They'll receive dollars, and those dollars will be worth far less than physical silver on the open market. Because the moment COMEX defaults, the paper price becomes irrelevant. Stage 3, the scramble for physical. Once COMEX defaults, every investor, hedge fund, and industrial user will panic. They'll rush to buy physical silver from any source available. Dealers, private vaults, miners, anywhere. Premiums will explode. Silver that trades at $30 per ounce on COMEX will trade at $100, $200, maybe $500 per ounce in physical form. This is called a short squeeze, and it will be the largest in commodity market history. There are 300 million ounces of short positions that need to be closed. There is no physical silver available to cover them. The shorts will be forced to bid against each other for metal that doesn't exist. Stage 4, systemic contagion. It's tied to gold, copper, platinum, and the entire commodities complex. When silver breaks, it exposes the same paper manipulation schemes in other metals. Gold will follow, then industrial metals. Then the credibility of every futures market collapses. Investors will stop trusting paper assets entirely. They'll demand physical commodities, physical real estate, physical anything. The entire financialized system, which relies on paper substitutes for real assets, will be questioned. Stage 5, JPMorgan cashes out. While the market burns, JPMorgan will quietly liquidate their 150 million ounces of physical silver at peak prices. They'll make $20 billion, $30 billion, maybe $50 billion. They'll pay fines if they get caught, and they'll move on to the next scheme. This is the endgame. The silver trap doesn't snap shut on the architects. It snaps shut on everyone who believed the architects when they said paper was as good as metal. The trap is closing. 28 million ounces, 800 million promises, a 3-0-2-1 gap that mathematics says cannot hold. JPMorgan spent 2 decades building a system designed to suppress silver prices and control markets. They sold metal they didn't have. They manipulated prices with impunity. And they convinced the world that paper contracts were real. But Basel III changed the rules. Industrial demand drained the vaults. And now the Ponzi scheme they built is collapsing under its own weight. The bank knows it. That's why they flipped. That's why they're holding 150 million ounces of physical metal while maintaining short positions on paper. They're positioned on both sides of the trade. When the system breaks, they profit. When it holds, they profit. They designed the trap to catch everyone but themselves. This isn't a prediction. This is forensic analysis. The inventory data is public. The delivery demands are accelerating. The math is absolute, and history is clear. When the paper exceeds the physical by 30-1, the paper becomes worthless. The only question is timing. Will COMEX default in 6 months, a year, 2 years? Nobody knows the exact date, but the sequence is locked in. Stage 1 is complete. Stage 2 is inevitable. And when Stage 3 begins, when the scramble for physical silver starts, the price won't rise gradually. It will gap violently. There won't be time to react. The silver trap isn't coming. It's already here. JPMorgan built it. And now everyone who trusted the system is standing inside it, waiting for the mechanism to trigger. If you understand what's been explained here, if you see the forensic evidence for what it is, then you know this isn't about investing. It's about recognizing when a Ponzi scheme is in its final stage. And the final stage is always the same. The insiders cash out. The believers get crushed. And the system resets with new rules written by the same people who broke the old ones. Subscribe if you want to see the forensic breakdowns they don't teach in business school. The ones that show how the machine actually works and who's operating it. One question for the comments. If you held a silver futures contract right now, would you demand physical delivery or take cash settlement? And why? The trap is closing. The math doesn't lie. And JPMorgan already knows how this ends.